Hi again, everybody. In today's video, I want to talk about the worst way to save and invest for retirement. I wasn't sure if I was going to do this video, but I thought, what the hey? I see this far too often, and I am just blown away that this is still happening today in 2023. So hopefully, if you're watching this video years from now, this thing that I want to talk about will no longer exist. The worst investment strategy that I'm going to go over today is investing in a life insurance policy for retirement income. This has gone by different names over the years. Sometimes you'll hear things like bank on yourself. That was a kind of a tagline that was thrown around for years, but essentially this is the idea. First, you start with an insurance contract. And this will be a permanent life insurance policy like a universal life or a whole life insurance policy. And this insurance policy will have a death benefit. Let's say $250,000. When you pay premiums into the life insurance policy, a portion of your money is going to pay for the life insurance component, that death benefit, the $250,000, and another part of that money is going into essentially an account where the money has either the potential to grow or it has maybe a guaranteed rate of return. Let's say it's a whole life policy and it has a guaranteed interest rate, right? So you pay a premium, you pay $500 a month, for example. A portion of that is going towards paying the insurance premium. Another portion of that money is going into an account sitting there, and it has the potential to grow or even a guaranteed rate of return, right? So the idea with using this over time is that as you put in money, the money that is going into the policy and growing will grow, right? Until eventually, so this is the way it's sold, eventually you'll have enough money saved in the insurance policy that you don't have to make insurance premium payments anymore, because it'll be earning enough interest that they can just take the cost of the insurance, take it out of the money that you've saved in there, and it's earning enough interest, it can easily cover that cost. And in addition to that, you can also take money out of this insurance policy tax-free, and you can do this through borrowing from your policy. This is where the whole bank on yourself tagline comes from, is that you don't have to go to the bank to borrow money. You can just borrow from your insurance policy, and when you borrow money, it's tax-free. Awesome. So as a retiree, now I can borrow money from this contract and get tax-free retirement income. Man, this sounds like a great thing. Not only that, there's an extra feature. When you die, the beneficiaries of your life insurance will get the death benefit tax-free. And let's say you've borrowed some money from the contract. Well, when the death benefit's paid out, part of that death benefit will go towards paying off the loan that you've borrowed from the policy, and the remainder will go to your heirs tax-free. And doesn't that sound like a great idea? You save taxes, and usually the sales pitch goes with a lot of really negative things to say about the government. Anyway, so there's a lot of problems with this strategy. Number one is it doesn't work. And maybe we could just stop there. It does not work. This has been a strategy that's been around since the 1970s, but in 1986, there were some tax law changes that made this technique horrible, made it so it didn't work anymore. It used to be that you could make the argument that this was a viable strategy decades ago, but it is not. So why does it still get pushed around? Why does it still happen? Well, I'll just share my opinion. The reason why this strategy is still pushed so heavily is because these insurance contracts pay great commissions to the agents that sell them. Also, when it comes to being an insurance agent, if you want to increase the people you can sell insurance policies to, now all of a sudden you can turn a life insurance contract into a retirement savings vehicle, right? I've seen horrible, so I think this is the reason behind it. When it comes down to it, it's a great way for an insurance agent to earn a commission, and there you go. I've seen some really horrible ways that this has been done. I have personally met people who've sat down with insurance agents who have tried to convince them to take out a second mortgage on their house and put that into an insurance contract to help fund their retirement. I have seen people that have been contributing to these types of insurance contracts for decades, and they just do not grow. The cash value in these policies do not grow fast enough to ever allow this contract to do what the insurance agent said that it could do. I've seen many times people that I've met with over the years, they've received something called an illustration from an insurance agent that has all these projections. Well, if you pay this premium and the contract grows at this rate of return per year, then you should expect to have this amount of cash value when you retire, and you should be able to borrow this amount per year. And then when you die, your heirs are going to you're going to pay off the loan, and your heirs are going to get, X amount per year of tax-free money. And within those illustrations, those are based on projections that are based on fantasy. The rates of return are just, they are so unrealistic. I'll just say from what I have personally observed. And usually within those big, thick illustrations that the insurance agent shows you, and they show you 1 or 2 pages, if you dig down somewhere deep in there, because insurance companies, I believe, are required by law to disclose this, you can look at another illustration based on the guaranteed rates of return. Usually the ones that the agent shows you are going to be based on very, very optimistic projections. But if you look at the projection based on guaranteed returns, you're going to see that this policy crashes and burns, does not work, will not provide retirement income, and will probably end with the policy lapsing because eventually the cost of insurance will just grow, and you'll be forced to just cancel the policy, reduce the death benefit, some version of that. But that is rarely, shown up front. The people that I've usually seen that sell these policies fall into a couple of categories. First is just the naive, the uneducated, the uninformed. So let's say you get out of college and you're at a job fair, a career fair, and you want to become a financial planner, and you see some big national insurance company that says, hey, come join us, and they tell you you're going to be a financial planner, and then all of a sudden you find yourself a couple weeks later selling these insurance policies to your friends and family, not really understanding what they are, but you've got some guy with you, your mentor or your supervisor, that's helping you do it, right? So these are the uninformed, right? Frankly, insurance companies taking advantage of young people, exploiting their family networks, their relationships to sell insurance contracts in a way that's totally inappropriate. Another version of this that I see are I would say people that are really trying to do a good thing, but they are also just completely ignorant. This is a pretty dangerous person, in my opinion, when it comes to finances. Someone that's trying to do a really good thing, but they have no idea what they're doing. They're not qualified, they're not educated, and they are going around with sincerity and with conviction, trying to help people that they know, by selling them these policies, and frankly, they're doing a lot of damage. So if you've purchased one of these policies in the past, it may be from a situation like this, from a family member or something like that, who was actually trying to help you because that's what they thought they were doing, even though they definitely weren't helping you. And I think there's got to be a category of people of agents that know exactly what they're doing, but frankly, it's an easy way to earn a commission. And when it comes to insurance contracts, once you've sold that contract, you have a very narrow window when somebody can cancel the policy. And so that agent walks away, they keep that commission. And if you change your mind, if you decide to cancel the policy, the insurance company has made sure that there are some nice surrender penalties. So you're going to have to take the hit and not the agent who sold it to you. So maybe just as a rule of thumb, when it comes to anything financial, like saving for retirement or whatever, it's a good idea to avoid things that have built into them these massive surrender penalties if you change your mind within some period of time, right? I mean, what is that? If the investment was so great, you wouldn't need a surrender penalty because people just wouldn't cancel the policy, right? But that's built in because the insurance companies know that after that policy is sold, they have to pay the commission to the agent that sold the policy. And there's a decent chance that the person who bought the policy is going to want to cancel it right away or within a short period of time. And the insurance company, they're in the business of making money. They're not in the business of paying out commissions and losing money that way. So they're going to make sure that they don't lose. The insurance agent wins, the insurance company wins, but you lose. So I'll get off my pedestal. So that is my least favorite investment or strategy or whatever for saving for retirement, is this cockamamie, horrible idea of using an insurance policy to accumulate money and get tax-free money in retirement. Okay, so hopefully that was helpful, at a minimum entertaining. If any of you, I should say one quick disclaimer. After watching this video, I'll just say, because I have experienced this myself, I'm not the only one that's talking about how horrible these things are. So sometimes somebody will learn about, oh, this is a really not the best thing for me to be saving for retirement. So I'm going to cancel this policy right away and do something different. Before you do that, stop, time out. Depending on how long you've been using that policy, or depending on your circumstances, it's worth looking over that policy with a competent professional, somebody who is qualified, educated, and can help you look at that policy, run projections, and help you figure out what is the best decision to make now that now that you've already bought that contract. What's going to make the most sense for your situation, because not every situation is exactly the same. And if you could roll back the clock, you wouldn't have, and you have this information now, you wouldn't have bought that policy. But who cares? Now we're at today. You already bought it sometime in the past. So before you cancel it, I strongly recommend that you actually go over it with a competent professional to see what would make the most sense going forward for your situation now. So that's my last disclaimer. Until next time, it's good to share some thoughts with you, and have a great day.